Everybody, we're going to start the live stream in 1 minute. So NVIDIA had their earnings, and we are watching the intro at the CES trade show, where they're really pushing, or I guess illustrating what the future of AI is going to look like and some of the use cases. And it's pretty impressive what they're putting out there. I think it is a little futuristic. Not sure how soon these things will be around, but hopefully it'll come around sooner than later. Would be cool to have some of these technologies impact daily life. All right, well that's good. Let's go ahead and get started with the normal agenda here. All right, everybody. So we made it to the evening session on Wednesday, February 26th, and today NVIDIA announced after the earnings, and uh, the earnings, I read them. I walked away from the report. I came back and read it again. Then I updated my analysis. So I'll share that with you. And uh, I thought the earnings were good from NVIDIA, and I thought their business, they executed really well. They had really good growth. If you look at the top line revenue growth, it was very good. Um, the only kind of small, I don't know, I can't even tell you that there's a blemish. The cash flow came in pretty close to where I had it on my model previously. So that was good that I was modeling that right. So all those things look good. In fact, I was um, a little surprised to the positive that their revenue is a little bit higher. So that was good for them. So what's a little strange is the stock has been going from positive to negative. Part of the afternoon, the stock was going down a little bit, then it went up, and it's come down a little bit. It's going to be tough to say what is going to happen. The earnings call is over. The comments have been made. So I'm not quite sure what the market's processing. Sometimes when we have earnings reports, it's kind of a surprise as to how the market reacts to a stock. Sometimes I think a company comes out with an earnings report and it looks good to me and it sells off. And sometimes an earnings report comes in and I'm like, I don't see how that earnings report was all that great. Like Intuit, I think this morning announced, or was it yesterday? And I think Intuit's a really good company. I saw their earnings and the earnings were okay. They were, okay to good. And the stock rallied 11%. I was like, whoa, okay. In the case of NVIDIA, I am surprised it's not going up. So um, I'm a little bit of a bear on NVIDIA. And I would say that the earnings actually moved me towards center. Like, no, that was a really good earnings report. This business is really firing on all 8 cylinders. And I'm a little surprised that the market's selling it off, but just a little bit. For all we know, it's going to open up tomorrow and just roar and go up 10%. We'll see. But for now, let's just take a look at the information we have in front of us, and we'll go from there. So I released a video, and I wanted to just come back and feel free to ask questions on NVIDIA. If you want to ask questions on NVIDIA specifically, awesome. I'll try to answer questions throughout the live stream and see if I can answer any of your questions. And then I'll review their earnings just slightly because I already did a video, and I'll go through my model. And again, if you have questions, please ask. And I'll also go over CRM, Salesforce, and we'll go from there. So thanks everybody. We're 10 strong early in the live stream. I appreciate it. Sorry about the intro gone wrong. I thought the graphics were cool, but you guys couldn't hear the sound. So I apologize for that. Shadow Guy, thanks for joining. Jay Zev, good evening. How are you? Sergio, thanks for tuning in. I know it's kind of late for you. Appreciate it. Carlos, good to see you. Huang Zhong, thanks for tuning in, man. And thank you. Thanks. You're thanking me for input. I appreciate it. I appreciate you joining. So Android PC, one of the regulars. All right, cool. And if you guys have a stock you guys want to look at, let me know. And let me turn off the banner. Thanks, Sergio. All right. So NVIDIA, the earnings, I'll tell you what I was impressed by, and I don't have any concerns. The revenue grew a little bit better than expected, and 78% growth is phenomenal. Data center did great. There was no comments on pushback from vendors or customers, excuse me. And looks like the conversion over to Blackwell, which is their new chipset, that's taken some effort, but customers are, giving it the go and trying to get it set up. So that looks good. So that looked really good. Revenue, profit looked good. Data center, as expected, looked really good. The other businesses, I don't know if they're material anymore. It's all about the data center. When we get into the balance sheet, cash increased as expected. No big surprise there. And I did get pretty close on my forecast for their cash. This cash is when I forecast the cash, and so what I'm trying to do is I'm trying to predict where the cash is going to land for NVIDIA. And I'm giving them a very optimistic forecast because, again, I'm more of a bear on NVIDIA. I'm like in disbelief of how high their stock price is. So I'd rather be wrong on the optimistic side, on the positive side. So I'm taking their current run rate of cash flow that we just got a new set of financials, and I'm increasing it by 25% in the field or the cell that you see highlighted in blue. Then I'm growing it by another 25%. That would be a $95 billion free cash flow number, which is very optimistic. When we look at their current cash flow, it's 64 from operating. Then you got to deduct, their CapEx. Here they did a little under 61. So I'm still saying, hey, they're going to hit 95. But I continue to believe that it's a cyclical business. Once everybody buys the GPUs they need, who are they going to sell them to? You're going to run. Once Microsoft slows down, Google slows down, AWS slows down, you're going to run out of customers. X just bought all their GPUs. Are they going to keep buying? They're going to go bankrupt if they do. So at that point, the cash flow is going to go down by 10% year 3, then another 10% by year 4, and then it'll grow by 4% into the future. Now, this is optimistic because if you have a cyclical business, which semiconductor tends to be, you'll have valleys. You kind of have big contractions in that cash flow in the future. I'm not modeling that just to make sure that I'm not overly pessimistic. Even when I give them all that kind of tailwind, it still doesn't add up to their market cap. The value of those cash flows is 1.6 trillion, and the market cap of the company is 3.2 trillion. That's those are the numbers. And if we got too crazy with saying, oh yeah, they're going to be a $200 billion free cash flow company, that'd be incredible. They're already incredible. So it'd be incredible times 10. So the stock is really priced 48% too high based on those cash flows. And we'll see. We'll see if it corrects back down to this intrinsic value. And we'll see. We'll have to keep tracking each quarter and see where it goes. The earnings per share does, get you to a stock price. In fact, I think the stock price is discounted by 18% if you look at earnings per share. But this is a less reliable number. Charlie Munger didn't use it. A lot of investors don't touch this number because it could be manipulated. It could be too positive and throw us off. This is the number, and this is the analysis that most, investors, value investors, long-term investors depend on. When we combine it, it's a 26% premium on NVDA. I still have a sell on NVIDIA. I think it's a really good business, but it's a great business. And if my value on them is 1.6 trillion, that's still a great, great value. It's a huge business. So that's my analysis on NVIDIA. And it's a little bit surreal to see that after the market closed, after us waiting as much as we did, it's not doing anything. It did move in the trading day, and it was kind of a down day today. It moved almost 4% to the upside, and it's giving up just a tiny bit. So that's a little bit weird. I would have expected the NVIDIA stock was going to move in one direction, up or down. All right, so Bear Light, you want to look at Nokia? Yeah, we can look at Nokia. All right, so that's NVIDIA. If you guys have questions on NVIDIA, I'm going to keep these tabs open and we can refer back to them. But it was, again, I was impressed with the earnings. I came away impressed again by NVIDIA with a little bit less doubt. Salesforce. Let's talk about Salesforce. So I thought Salesforce going into their earnings was setting up to do well. And I did my analysis, and they didn't provide enough positive guidance for the market to rally. They did come in and meet expectations, but then they guided. They're growing at roughly 10% top line revenue, and they guided next year they would grow 7 to 8%. And Salesforce is known to kind of give a conservative number, a sandbag number, and then always beat it. But the market didn't like that. Hey, if you're not going to grow at 10% like you did in this past year, 2024, then we're going to sell you off, I guess. It has been on a pullback. And when you look at their earnings and you read through the highlights, they're really going after the AI use cases. Agent Force is what they're branding their AI applications to be. They're really saying, hey, we did $900 million in a data cloud and AI reoccurring revenue. I'm sure they're reclassifying some revenue. They already had it, and they're just calling it AI. So they could say, hey, look, we have close to $1 billion revenue business from AI. And so they really highlight AI at the very beginning of the earnings, trying to position themselves as an AI company. Now, that looked, I thought the sales for the past year were good. And I guess the guidance was a little bit disappointing. But the cash flow is still really good for Salesforce. That didn't change. It's still just as good. And that's where I'm basing, when we look at Salesforce, I'm still basing most of its value from those cash flows. Those cash flows are massive, really high cash flows, and they keep growing them. And when I do a forecast on those cash flows and then discount those cash flows to today's value, get a very big number, well above its current market cap, its current stock price. The earnings per share is probably has the stock fairly priced or so, but overall it's a nice discount. And if it sells off by 5%, that discount's going to look even better tomorrow. As I look at Salesforce, it's a buy for me. This is a really good business, and they're a big business. These guys are not going anywhere. If they continue to grow, they're just going to continue to get more valuable. They're very powerful in their industry. They have very good barriers of entry. You think about the dominance of Salesforce in the customer experience, CRM and service and so forth. This is the top company, and they got there because they just did it better than everybody else. They also are very hard to replace. Businesses that use Salesforce, it's very hard to get out of it. It's, these businesses don't want to unplug the Salesforce stuff because then they'll disrupt their own revenue streams, because Salesforce is tied to the sales process, the service process within a company. So all those things I think are good long term, and I am going to continue to buy Salesforce stock. On this pullback right now, Salesforce is down 5%. And if we look at year to date, it's down 8%. Maybe it's going to be down about 13% at the end of tomorrow's close. For the 1 year, it hasn't done much. And that was one of the things that I thought was interesting, is technology's just been flourishing and this stock's been left behind. Forward P looks great, 28, really big, valuable, growing software company that has great margins. I still think it's a really good opportunity. So I'm gonna buy into Salesforce and own a good chunk of that company. All right. So one company that is in the semiconductor space, it's not very well known, is Synopsys. And Synopsys provides electronic design automation software used to design and test integrated circuits. So what that is like when a semiconductor company designs a chip and then they have the prototypes or their first samples manufactured, they need to test that chip and somewhat certify the performance of that chip. That's what Synopsys does. And we're having more and more innovation. For example, NVDA has Blackwell, and all the other companies, AMD, Intel, they're all testing their chips with Synopsys or another. They have one more other competitor. So these guys, I was curious to see how they're doing. They announced their earnings, I believe, before the market opened. The stock did go up, and it's still going up in the after hours. So that looks good. For the 1 year, the stock is down. So is it beginning to catch a lift? Now, I recently, a couple months ago, started buying into Lam Research, and I'm doing well with that stock. Lam Research provides materials and kind of a lot of the machinery that the semiconductor needs. It feeds that particular industry, and that stock's doing well. Synopsys in a way is part of the same ecosystem as Lam Research, but they do the testing. It's a software application. It's a system. And I wanted to see if this thing maybe is it discounted and worth considering an investment in it. Its forward P is 31. It's a $72 billion market cap company. All right. And let's look at their revenue. Revenue has been growing. See that consistency? Real consistent. So very nice revenue growth at 15%. Good cash flow, but not great cash flow. This cash flow is a little bit low. I wonder why that cash flow is so low. So margins are really high. Profit margins are really high. And then the cash flow is 21%, which is good. So the revenue is $6 billion. So you're paying about 12 times revenue. I'm a little surprised. Let's see here. So yeah, it'd be tough to get to that market cap with free cash flow at this level. It's this I could imagine this stock being worth maybe 35 to 40 billion dollars with that cash flow number. They have plenty of cash. They have more cash than debt. They have $1.28 billion dollars of cash once you net out the debt. So this one's a little expensive, and I can understand the market selling it off. It was really going up for a while. Maybe it was that whole, hey, the semiconductor companies are going to boom, but it's really faded. It's faded probably for the past year, obviously. It's down 18%. And it's lacking that free cash flow to substantiate their market cap. So I thought I'd take a look, see what they're all about. And it looks like it's going to be a pass for me on that one. So we went over NVDA, Salesforce, and that was Synopsys. Mike, the dividend investor guy. I wonder if CRM will drop tomorrow. Normally, when it drops after hours, the market would drop the morning. If it does, I may steal a few shares. Yeah, 5% drops a pretty good drop. And what's the pre-market doing? Is the market supposed to? It's not telling us much at this point. A little bit green on the Nasdaq, but we have to look at a reasonable kind of open. It's probably an hour before the market opens. So right now it's just a guess. At least it's not red. It's not like, oh man, it's going to sell off a lot. All right, so that is Synopsys. Now, a company that I kept wanting to take a look at is Lemonade. It went down a little bit today. It announced yesterday, and these guys do various insurance products through various channels in the US, Europe, and United Kingdom. Its insurance products include stolen and damaged property, personal liability. Okay. Renters insurance, homeowners, car, pet, and life insurance products. Landlord insurance products. Okay. And the reason it catches my attention is insurance has really done well. If you look at insurance companies over the last couple of years, they've been cleaning up. They've been making really good profits. So this is a $2.3 billion market cap company. Revenue is $526 million. They're not quite profitable yet. They have been growing really well. They are small, but they're growing really well. They're at 526. Okay. So they don't have gross margins because it's insurance. Operating margins, they're losing money. And overall, they have negative free cash. So I noticed this company and I wanted to take a look just out of curiosity to see what they were looking like. It looks like this might be a little too soon to get into. All the numbers are negative. Will they make it? Maybe, maybe not. Maybe they'll become irrelevant. Looking at the quarterly, they did accelerate their growth to 29% from 18%. That looks good. But this one might be a little too green. Got to let it kind of mature a little bit, get a little bigger, start making some profits, start generating some free cash, and then it could be a good investment. So Lemonade is going to be a pass for me. All right, I think somebody wanted to look at Nokia. And Nokia, I know it's in Europe. Let's see here. It's this one here, Nokia. Yep. So this is a $4.90 stock. Okay. Man, it's been doing well for the 1 year. Not so much for the 5, but the 1 year looks good. Its market cap is 26.6 billion, revenue is 19 billion US US dollars. Okay, good. Forward P looks low. Okay. So these guys are more into communication equipment and communications. Of course, at one time they were selling a lot of mobile phones. They were really known to the consumer because a lot of people used Nokia phones. I remember when they were in the market and had plenty of phones out there. They are negative contracting revenues, but they did have a positive quarter where they grew their business a little bit. They will announce on April 24th. So we're a month and a half from that happening. Now, so gross profit. So they have margins of 47% the most recent year, and their free cash flow is $2 billion. That's very good. But the cash flow is a little unpredictable. It's been kind of it went up and then it came down. Now it's up again. So it's a little bit hard to predict what's going to be next. Is it going to go back to, like 700 million? Is it going to go up from 2 billion to a higher number? That'll be tough to gauge. Gross margin looks okay for their type of business. So at 2 billion, they're not really growing. They haven't proven to be a grower again. And they've had kind of contracting years, one growth year, contraction, growth, contraction. So this business is 15 to $20 billion in value. That's assuming they don't have any debt. Let's make sure of that. So they don't have any debt. They have a lot of cash, $3.66 billion of cash. This business I'm not all that excited about because why would I buy Nokia? What are they doing that's going to make them stronger, more valuable? I'm not seeing it. I'm seeing a business that's just kind of hanging on and just existing without a growth, without either the products that it can grow with, the strategy that it can grow with. It's just not there. So this is a pass for me. This business I think maybe it caught some attention because it's gone up 38%. A lot of people still recognize this name like I do. And it had a good year, but look at the 5-year. It's really has underperformed in a big way over the last 5 years. So it would be a pass for me. I would have a sell opinion on Nokia. Thanks for asking. So blocks for fun. Thanks for joining. You want to look at Oprah. And that's Opera Limited. Opera Limited, together with its subs, provides mobile and PC web browsers and related products, services in Norway and internationally. The company offers mobile browser products such as Opera Mini. All right. Okay. 1 year, it's done really well. 5-year, it's done well. Wow, look at this rise. It did that in 2023 and then it came back down. But overall, it's done really well. Small market cap. We're looking at USD, US dollars. Revenues of 447 million. Net income of 159 million. Okay. Really low PE. That looks really, really low. High dividend. It's a strong buy. And this is it's listed as a communication services company, but they're creating a browser. It might be more of a software play, but tomato. I think those industries kind of intermix. or those sectors, I should say, intermix. This company is growing at 17.8 percent, and in the last quarter, it was 20%. So that looks good. It is small, but it's growing nicely. All right. Free cash flow is there, 84, and it has been rising. That looks good. Gross margins are good. Okay, so looking at their balance sheet, they have about $97 million of cash that after you deduct debt. So these guys are fairly priced. I don't see a big discount. I think they're right there. You could say they're maybe discounted by 10, 20% if we did all the calculations. They're just not a high grower, and they're small. They're outside my home country, so I'd have to hit them with a higher discount rate. I'm not that close to this business. I don't know how successful they are. If you're in Europe and you're familiar with this company and you have really good knowledge of them, maybe you'll be very comfortable with them. It sounds like you can run a browser, and basically you don't use Google Chrome. You would use their browser, and it's supposed to do some things for you. Okay. So they give you privacy, all these things Chrome is going to give you. It's good that they're growing, but I don't know that they're if they want to replace Google Chrome or Microsoft Edge is what they have. And those are two big giant companies. These guys could probably operate really well for their region and provide value. But this one here, it's just not showing me enough value, and it's outside my home country. And I'm not seeing enough value to go after it. I don't think their addressable market's big enough. I think they become bigger, they're going to compete against Microsoft and Google Alphabet, which is really, really tough. But if you know this business and you're in Europe and you think, no, these guys are better than those two you just named, and I know that because I live in the area, great. That might give you an advantage, an edge against investors that don't know. Or maybe you do live in the region and you're like, it's a small company. It's not all that exciting. Again, you have that knowledge edge. They're in Norway. I have no idea if these guys are super popular based on their fundamentals. I mean, they're growing nicely, but they're really small. So growing at this rate, they're going to be small for a long time. And I mean, Google Alphabet's gigantic. They're the leader in browsers with Chrome. So we'll see. And then, of course, the other browser is Safari by Apple. So those are three giant browsers that if these guys want to compete against those businesses are gigantic. So Mike, you owned nice work. So you owned it, you made some money, got a good gain, and you got paid a dividend. Nicely done. And blocks for fun. Their browser is really nice. Cool. Good. Do your homework on it. And it's just in a region, right? I imagine I went to their website. I don't know if they're going to tell me like which regions. I think if you went to the investor homepage and understood what regions are they selling into, where are they growing, maybe they break that out and you have a better sense of the business. If these guys can get a little bigger, I think they'll become more interesting. For now, they're right there. They're valued fairly. And after a year like this, and 5 years like this, it's kind of like, well, maybe the stock is valued fairly and it's not going to go up very much, but it could come down. If we have a nice bear market here in 2025, especially really small caps are just going to get really priced down, because that's just what happens is people flock to safety. They like big brands, like the big stocks. They go into bonds, and they sell out of these small stocks, and they don't have any appetite to go into small caps. So for now, this is a pass. Thanks for asking. Looks like Nick, you want to look at is that Paramount? Paramount Global. So these guys are being acquired, right? Yeah, they're merging. They're being acquired. Over the 1 year, 0.09. But I thought they were being acquired. So they announced. So they're merging. So it's not like people are buying the stock. It's just a merger. Okay. That's why there's no premium being paid. Wow, man. It hasn't been a pretty picture for the last 5 years. Even the last year, just pretty much sustained their business barely. $7.5 billion market cap, but their revenue is way up there at $28 billion. Wow, man. You're getting a big company for a very small price tag. Forward P is only 8. Dividend is almost 2%. So it has been contracting a bit, but I still am. Why aren't they worth more? They have a big revenue number, and I know that they create some really good content, and they own CBS channel 2 where I live. They have NFL on their channel. They have good shows. Their streaming's got to be doing something, a little bit of revenue. Their gross profits there. Okay. We go to, they do have some free cash flow. That free cash flow is right in line with their valuation. You multiply this by 10, you get up to their valuation. And gross margin's okay. It could be a little bit higher. It's just expensive to be an old media company. All right, so that's that one. Analyst 11 of them cover this. One thinks the company's worth $19 a share. The worst case scenario is $9.50. Now this stock here, it's interesting you ask me about it. If they're going to merge and they're expecting the merger with Skydance, it's supposed to close in the first half. So I guess by the end of June. Well, when that happens, is your shares are going to be called away, right? You're going to be paid money for your shares, not at a premium, unless I'm not reading this right. And so there's not a lot of upside there. It's just going to be a stock. Maybe it goes up a little bit. Have you studied the price that is going to be paid for each share? That'd be the homework, because there might be. I don't think that's going to tell me. And the only positive is if the merger just going to take the shares and then say, hey, this was the closing price on this date, so we're going to give you that amount of money, or are they going to give you a premium? I don't think they're giving a premium, or we'd see the stock really go up. Instead, it's just been going sideways ever since it was announced. It's just going sideways. So this one here is just kind of waiting to be merged and be a part of Skydance. So earnings came out today, down bad. Yeah, they're down a little bit, 2%. And then so they're supposed to be paid $15 a share is what the agreement was. Really? Huh. Well, if they're going to pay $15 a share, man, I would totally be interested. So I'm going to look into that. These guys I haven't looked at them in a long time, but when I looked at them, they had a lot of debt, and they still do. $13.25 billion of debt. Debt to EBITDA, debt to EBITDA, 5. Whew, it's a lot of debt. So it looks like the merger is actually a positive because, they can hopefully pay off some of that debt and get the company better capitalized, and they can do better in the future for their employees. If you are confident that they're going to pay $15 a share, I mean, that's a pretty good return, right? You'd be paid upwards of $4 more per share. That's like a 30 some odd percent return. So I would do my homework there and see if that's going to happen. That might be worth buying some shares. And I'm going to make myself a note to investigate that. Yeah, because usually the market's really efficient when you have a merger, or I should say an acquisition. The details of that deal are kind of disclosed, and then the stock starts trading pretty much close to that value. That's why I was like, hey, there's no premium here. If if the information that you're putting on the chat is like they're supposed to be paid 15%, why isn't it trading closer to 15%? Is there risk or concerns that the deal's not going to happen? Um, I forgot when it was announced, but see, this kind of makes sense if the stock started to fly up toward $15. So that's an interesting one to investigate, see if it's worth buying and being a part of the merger if they're going to pay you more money. All right. So other stocks that were having their earnings announced. TJ Maxx is a discount retailer, not my favorite industry, but the stock did trade up. Over the 1 year, it's up 25%, pays a small dividend. And man, this stock's done well, up 109%. $140 billion market cap. Wow. These guys do retail. It's kind of discount retail. And they tend to have real estate footprints that are less expensive. They don't have like those big expensive stores, like the big department store that classically, big retail would have. These guys don't do that. They instead have a less expensive cost model, and it's working for them. They have revenue of 56 billion. And if we go into a recession, these guys are recession proof because they're a discount retailer. They're listed as consumer discretionary, but it's kind of affordable consumer discretionary. It's not like big expensive stuff. People go there for good deals. Forward P is 27, strong buy, but only discounted by 6%. It's a slow grower. Last couple of years, just been kind of slow growth. This stock has done well over time, obviously, and it's built kind of a good stock brand. Like people believe in the stock. So that's why the stock's really trading nicely or at a high price. It is contracting a tiny bit in the most recent quarter, which is the quarter they just announced. So they're not growing. And their free cash flow is 4.2 billion. They're not growing. And what kind of debt do they have? So they have net $7.44 billion of debt. So they have a little bit of debt. I think these guys are worth like 40 billion tops. The reason for it is their cash flow is okay, but it could substantiate like 40 billion. Then they have some debt. So I'd have to deduct that debt. 140, I don't see how this company is worth that. They have a lot of employees, 350,000 employees, was it? Yeah, that's a lot of employees. You got to manage those people, buy insurance. You got to, rent out real estate. It's just not a business that's really attractive to me. Their margins are going to be in the 30s or so. Here we go. Profit margins. Their gross margin is 30. So this is like, okay, it's a business. But once we get to profit margins, that's pretty low. Free cash flow margin 7.45. That's pretty low. You can get into, good technology stocks or pharmaceutical stocks. You're way up there, 20, 30% free cash flow margins. Profit margins, you're way up there, 20, 25, 30%, profit margins. And the gross margins, you get up there north of 70%. I'd rather play in that space. This space is for somebody else, somebody that understands this business. And frankly, that investor did well with TJX. But it's just not my cup of tea. I'll stay in my lane and keep going after the sectors and industries that I find attractive and I like to investigate and understand. Lowe's announced. So, and let me try that again. Now, Lowe's and Home Depot kind of tell us a little bit about the economy, right? Because they're so darn big. And these guys are not as big as Home Depot. Over the 1 year, this has done 6%. It was up 2%. They announced their earnings before the market opened. They're targeting the professional contractor. They are contracting. Look at all these quarters, negative. So this doesn't look good. And this makes sense, right? Like we're not in a hot economy. It's not like, man, the economy's growing like really fast. No, it's just kind of a stagnant economy. It's just barely growing. There's nothing big and exciting. I think there's not a lot of home sales going on because prices are so high. And Home Depot and Lowe's probably make money when people move. They move and they want to remodel and they want to recondition stuff. I think when we hit COVID and people had some extra money, especially with the stimulus checks that went out, people were really remodeling back in 2021. They wanted to make their homes nicer because we were all asked to work from home and kids were asked to do school from home. But those days are over and now they're not growing. So that doesn't look good. I wanted to take a peek at Home Depot. They announced, I think, a day or two ago, the 25th. So they announced yesterday. They're like they're 3 times bigger than Lowe's. So they've out operated Lowe's. They're also they have a higher market cap. They're growing a little bit. And in fact, their latest quarter looked pretty darn good. So that looks good. But like other retailers, these guys, let's see, their gross margins, 33%. Profit margins are okay, but it's just a retailer. And when we look at how many employees do these guys have? 463,000. Wow, that's a lot of employees. And I'm a Home Depot customer. I go in there and buy stuff for my home, the properties that we own, where we have to get some stuff. And it's a well-known business, big market cap because it's such a well-known business. But I think there's other businesses that I'd rather own. I think this one's done okay. Let's see how it's done over the last year, up 5%, and over the 5-year, 64%. So it's been okay, but it's not great. It's been steady. I would give them that much. You can probably buy this at good prices. Like if you bought here, or maybe even buying it now might be a good idea. Home Depot should do well in recessions because it's such a well-known name and, people are going to keep, their home maintained, and then landlords are going to keep, the homes that they rent maintained. And some of the stuff that you get at Home Depot is a consumable, like it's a staple. So it should do well in a recession. And you see they have mostly green numbers year after year. They had 1 year of contraction for the year that ended at the very beginning of 2024. But it looks like the year that just ended now did quite well for them, single digit growth. So Home Depot looks like a well-operated business. It's not my favorite sector. It's consumer discretionary, home improvement. It's retail. I try not to do retail unless it's obviously a good deal, but it's not my preferred industry and sector. So that's Home Depot. All right. So we have, so one thing about, the futures have gone negative. Oof. One thing about the market that was a little spooky is the market rallied, first couple of hours of trading, and then it gave up those gains. It actually went red, and it barely edged a gain today, just barely on the S&P. And that just, shows that the market's nervous. And looking at the 5-day, it's clear that the market is nervous. From the top to where we're at now, down 3% year to date. The S&P's, pulling off a small gain. I think the NASDAQ is the one that is in the red for year to date. Yep, it's in the red. So the market's a little nervous. We may open down tomorrow morning. We may stay in this nervous state. We are, the NVDA earnings are out, and NVIDIA is not it's not going up or down a whole lot. Now it's down a little bit, 1.5. But this was something that, I was seeing headlines earlier in the week where, can NVIDIA get us out of this, bear market? And it looks like it's probably not going to happen. It's not going to be like a superhero coming in and saving the day. I don't know that NVIDIA is going to sell off a whole lot, but it's not causing this big push of enthusiasm of, hey, great, NVIDIA's going to pull up all technology stocks. I don't think that's going to happen. So I think we're going to deal with a little bit of a crummy market tomorrow, and we have a crummy period, but we shouldn't complain. I'm not going to complain about the last couple of years, right? Hey, thank you for all these gains. You made me wealthier. You made me have more, my stocks be worth more cash, buy nice cars, go on nice vacations. Thank you, stock market. So yeah, if we have a period where we have a month, 2 months, 3 months of down prices, I'll use that to my advantage. So that is what I'm seeing out there. Crypto is, Bitcoin's down to $84,000 per coin. That is a nice little haircut. It was above 100 not too long ago. Asia did do well. Chinese stocks did well. My BABA stock went up today. That looked good. We'll see where it goes tomorrow. All right. So Mike, the dividend investor guy. For the most part, we're mostly Americans, so we are very good at complaining. Yeah. All right. I'll try not to complain anymore. Do you mind taking a look at WDC? Let's take a look. Western Digital. I think these guys do storage, right? And before I jump into that, let me see here. Good to hear. Okay, cool. Hopefully you're doing well with Home Depot there. You're making some money. Home Depot is just such a recognized name. It's one of those like Costco. People feel really comfortable with Home Depot. They feel really comfortable with Costco. So good luck with it. I hope it keeps going up. Western Digital develops, manufactures, and sells data storage devices and solutions in the U.S. So they do storage. Long time ago, they were really good at hard drives. And when everybody needed a PC, these guys were flourishing. 53,000 employees, founded in 1970. Okay. And just to give you guys a bird's eye view of what they do. So this is Western Digital. They do, these hard drives go in our computers. Okay, cool. Like this one's probably a solid state hard drive. Got it. And it's a $17.45 billion market cap. Wow, look at that. Nice valley. And the stock has been working for the last 2 years. I mean, that must have been a really nice rise. Up 18%. Year to date, up 11%. Okay. So you're buying the business for almost 1 time sales. Net income is 1.21 billion. Low forward PE. Now, this is a hardware vendor, and these guys usually don't make a lot of money. They're a buy, and they're supposed to be discounted a lot. But let's look at it together here. Wow, look at this growth. Now, I did hear that PC sales are supposed to be growing, and I'm beginning to believe it. That's a lot of sales, man. 38%. I heard PC sales are going to go up because I'm a Hewlett Packard HPQ stockholder, and that's where I've been hearing that PC sales are growing. And somewhere else, I heard PC sales are growing. So that looks good. These guys announced recently. They're going to announce on April 24th. Okay, so the growth looks really good. Let's take a look at free cash flow and margins. So they're producing free cash flow, not a lot of it, but they're producing some. And when we look at their gross margins, 34%, not bad. Some hardware vendors are like if you look at Super Microcomputer, they're like 15. It's like, oh man, good luck with that. 15% gross margins. Profit margins, man. These net profit margins and free cash flow margins are terrible. I don't like that. Yeah, this is a pass for me. Just a hardware business. I may catch a nice upward swing, but over time, it's just not going to be that valuable. See how the market sold it off. And I think there was a big demand for PCs because in COVID, people had to refresh their PCs so they could Zoom into meetings, and kids had to get a better PC so they can attend class. So there was big demand, and it created a spike, and then it sold off. Another spike was created, and the stock did well, but this is just not a business that I want to be a part of because their margins are super low. And these guys will continually compete against, other hardware vendors that are coming out with hard drives. And this technology keeps getting better, but prices keep getting smaller, which isn't good. You want a space where you can you want a business where you can increase prices and increase your margins and not have them contract on you. So this one here is a pass for me. It's just not a desirable business for me, but I appreciate you bringing it up. I'm really impressed with their growth, but it's just not the type of business I want to be a part of. If this free cash flow is a lot better, like Hewlett Packard HPQ has very good cash flow. This one doesn't. And then their margins are not good. So I will pass. All right. So thanks for asking on that. So no reason to look, but nice has continued to drop fast. Yeah. So that one is making me scratch my head. It's probably because, it's outside the US. It's headquartered in Israel. That might be part of it. But I still think that the business is discounted. I mean, I was never going to invest a lot of money in it, but it's not doing well. It's really come down fast, and it announced last week. And since that announcement, it's really sold off, which is concerning. Now you have Salesforce that announced, and their stock is selling off. So the market doesn't like these software companies, even though their margins are terrific. I'm scratching my head. I'm like, what's going on here? So it is consistent with what Salesforce is doing. These guys are in the same space. They do something similar. And I thought that in 2025, software companies were going to, begin to really thrive. Some other software companies have done really well, but some have really been lagging. Nice. Looks like Salesforce, Adobe. They've kind of been lagging, but their stock prices have been lagging, but the fundamentals look really, really good. So we'll see when it starts to work. I'm I think over the long haul, it's going to work. There's just too much money there. There's too much cash. There's too much growth. Fundamentals look great. I will wait around for the market to realize that fundamentals are worth paying for. And yeah, we'll see. We'll see if you can get that buy price. I will buy it as well. Hopefully, I don't have to buy down to that price, but we'll see. All right, guys. So got through the list. We didn't cover as many stocks as we did this morning, but maybe that's part of it is there's not a lot of stocks left. It is a little weird that NVIDIA is not causing more excitement, but we'll see. Maybe in the morning it will cause a bunch of excitement, and we'll see where it opens. We shall see. I appreciate you tuning in to the live stream. And if you have any other questions, you know where to find me. You can find me on the channel. You can get on our Discord and interact with us there. And of course, you can join another live stream. I'll try to stream again, probably on Friday, and we'll go from there. Everybody have a good night. I appreciate you joining. Take care.